Coming up in today's review, stocks finish mixed, bullish magazine covers, inflation data due out tomorrow, Bitcoin rips higher again, along with gold sitting at all-time highs. And it was a bit of a mixed day to start this week off. Saw a bit of a follow through in the fall on Nvidia from Friday's big bearish engulfing candle that we saw in a lot of hot stocks. AMD coming off, bit of a pullback in Meta as well, and a continued rotation into the other stocks that hadn't been doing too well lately, Alphabet and Apple, along with some further buying in oil and gas and consumer defensive, still seeing a little bit of that rotation. S&P 500 was basically flat. Magnificent 7 came off 1.5% as a group, and we saw a bit of weakness in small caps today as well. And just a quick update on my custom indicators. I've just added the new indicator trend strength to my chart here, and that's replaced range strength, and it's basically the opposite. So when this is positive in the blue, that means the market is trending, and when it's negative in the orange, that means the market is ranging. And for anybody that's bought my all indicator package, this has been added to your account today. So just restart your TradingView platform, come up to indicators, and you'll see it in your invite only scripts. Just scroll down and add trend strength to your charts. I've also created a new chart layout, which I'll refer to on the daily review now. That's my market analysis chart. Looking at the S&P 500 here, it's got my market risk on off indicator, which shades the background of the chart. When it's shaded green, that means it's in a risk on mood. When it's shaded pink, that means it's in a risk off mood. Then we've got the wave flow indicator to help us visualize the trend. Down the bottom is the S&P 500 oscillator, which lets us know if the market's oversold or overbought. Looks at a lot of different things like breadth, volatility term structure, and other market technicals. Then we've got the sector trends table indicator that gives us a bird's eye view of trends in the market and where all these important assets are relative to the 5, 20, 50 and 200 day simple moving averages. And interesting to see we can see yields in a downtrend on all time frames in addition to the dollar index, both of which are good for stocks, and that's why we can see pretty much every single stock sector above the 200 day long-term moving average. However, interesting, we've got discretionary versus staples and growth versus value, both downtrending in the short term here, along with momentum, semiconductors, and consumer discretionary. And I'm putting some finishing touches on another 4 new indicators due out next week, where I'll continue building out my chart layouts of market analysis, technical analysis, and my fundamental analysis charts. So I'm excited to share those new ones with you guys next week to give us all better insights and understanding of the markets. And there's a look at the VIX today, actually getting up a bit above 16, and a little bit of backwardation in the VIX term structure as well. Got the VIX 1 day at 19, 9 day at 16.5, the VIX 30 day at 15.2. Option dealers pricing in a little bit of volatility tomorrow with CPI inflation data expected first thing in the morning before markets open. And going into that, we've got the 2-year government bond yield holding ground at 4.53%. And there's a look at the most important stock in the market, Nvidia, following through on Friday's big bearish candle here. Lower lows, lower highs today, still doing a lot of volume, finishing off 2%, but we can see here in the trend strength with a current reading of 28, which is pretty strong. So there's still a bit more confirmation needed before we could say this is a top. We may come up and retest, then it loses its momentum and potentially put in a topping pattern. However, that may only be a short-term pullback before we go on to $1,200 a share later this year, making it the largest stock in the world. However, stick with me because I'll come back to the charts a bit later on. First, let's just look at a curation of news, research, and data applicable to today's market. And so like this piece in the Wall Street Journal says, it isn't just big tech propelling gains in the stock market anymore. There are a broader group of companies joining in on the rally as well. We can see that the equal weighted S&P 500 also catching up to the main index and breaking out, and quite a huge rally in the Russell 2000 small caps ever since the Fed pretty much signaled to the market that they're on pause and looking to cut rates soon back in October last year. Just before that, small caps were down about 33% off all-time highs. Now currently only down about 14%. So still a bit of catching up to do to the S&P 500, which is at all-time highs. But there's been a strong rebound in smaller stocks in the market. And with that, breadth and quite a few sectors breaking out like industrials and home builders, aerospace and defense. And if all goes to plan, it should be another positive year for the stock market. Analysts are expecting overall annual earnings growth above 10% for S&P 500 companies this year, and even higher next year. That coupled with lower interest rates and nothing really breaking in the economy, it's all the ingredients the market needs to rally higher. And looking at the equal weighted S&P 500 forward price to earnings ratio, it's not all that high, around 17, showing that there are some domestic companies out there trading at reasonable valuations. And according to investing billionaire Ken Fisher, stocks don't even need Fed rate cuts to keep soaring this year. He pointed to the stock market's run up last year despite no rate cuts, saying that that's a sign there are more important levers pushing stocks higher. Also adding, rates don't have the effect on the overall economy, and by extension then, the stock market that many people think. Noting that GDP actually accelerated over the last 2 quarters, despite higher interest rates in the economy, finally saying interest rates are just one mechanism of a very large system. However, I think it's safe to say that interest rate cuts are coming, with even Joe Biden recently saying, I bet you that little outfit that sets interest rates, it's going to come down. So he's banking on lower rates. That's a pretty strong signal to Jay Powell to do his job there, and that should give the Biden administration their best chance of being re-elected. With lower rates, if they can keep oil below $80 a barrel, that'll help as well. And all this optimism has finally made it to the magazine covers. We just saw a bit over a week ago, The Economist come out with its latest cover, How High Can Markets Go? Big bull, attached to some balloons floating up into the sky. Now we've just got the latest from Barron's over the weekend with the title Bet on the Bull. Stocks look poised to keep rising thanks to strong economic growth. However, a lot of people are noticing this. So is it really that obvious to go in the opposite direction? Well, like we've seen in the past, these magazine covers can be good contrarian indicators. However, they don't nail it right down to the month. They can be a year or so early as well. But rather it's just a sign of the times. However, to keep that party going, we need good inflation prints, of which we'll get February numbers tomorrow. Economists forecasting a monthly gain of 0.4% in the Consumer Price Index CPI and a 3.1% year-over-year increase. And just looking at the headline CPI, that's pretty much been flat now, coming up 9 months. Actually bottomed out 3% in June last year. Pretty much been tracking sideways. Then looking at core inflation, which is less the volatile inputs of food and energy, that's pretty much flatlining as well, just below 4%. And you got to remember what's really helped inflation this last year and a half come down is oil coming down. And so just like oil, inflation's kind of been flatlining this last half a year or so. And we have been seeing shipping and cargo rates move up these last couple of months. A lot of disruptions coming out of the Middle East and Red Sea could be filtering through to our food and other products and services. So if CPI did come in a little hotter than expected, that could test this stock market rally that has pretty much been based on the Fed pivot and them cutting rates. So that assumes inflation keeps coming in as expected, has to at least flatline, if not keep downtrending, for that narrative to hold ground. And looking at Fed Fund futures, they're expecting it to come in line, given no probability that we'll see a rate hike in this cycle, and still about 70% chance Fed's going to cut in June. Been a bit of a lid on bond yields. Got the 10-year still trading a bit above 4%. And with that, that's helping keep the dollar index in a sideways trend here, pretty much consolidating in the low 100s, which in turn is supportive of the price of gold, holding ground just below all-time highs of $2,200 an ounce that we saw on Friday afternoon. And it's a little interesting. We got gold breaking out to all-time highs. We've also got Bitcoin breaking out to new all-time highs, getting above 72,000 a coin today in a strong trending market. And both of them ripping to new all-time highs may not be all to do with the prospect of lower rates, a weaker dollar. With Bitcoin, there's likely the excitement going into the halving next month, which happens every 4 years and reduces the supply at which new Bitcoin can be mined, and historically is a time when Bitcoin does perform well. And the industry is definitely experiencing a resurgence. You can see that with a bunch of new meme coins, altcoins being listed and rallying up, a lot more activity and positive sentiment on social media. Just keep in mind the majority of altcoins launched since 2020 are dead. However, we're already seeing a wave of new ones. And looking at projections based on past bull markets and other people forecasts, a lot of bulls are saying somewhere between 200,000 and 350,000 is where this current rally could take us. We've even got frontrunner for this year's US presidential election, Donald Trump, coming around on Bitcoin after he previously labeled it a scam, saying today there's been a lot of use of that, and I'm not sure that I would want to take it away at this point. With him also adding it's an additional form of currency, and I used to say I want one currency, I want the dollar, I don't want people leaving the dollar, and I feel that way, but I will tell you it has taken on a life. And that could be important because his odds of taking the presidency later on this year continue to grow by the week, with a cumulative probability sourced from sports betting books of Trump winning now at 53.8%. That's a huge lead over Biden. And with Trump likely to take the US presidency, political games withholding, that means he may not clamp down on Bitcoin, and that was likely a further bullish signal for the market today, helping it to break out to all-time highs. It's also good news for Ethereum, getting back above $4,000. However, it still has a little bit more work to do before it breaks out to all-time highs above 4,900. And with gold, could also be a case of a bit of a flight to safety, maybe a bit of early repositioning of a potential rotation out of risk assets, a bit of worries about geopolitical tensions, increased buying from central banks around the world trying to get off the dollar. And so the higher gold and Bitcoin goes, you could kind of think of that as an attack on the US dollar, of which the US government might actually bite back and try and defend the United States' most important asset. And that's the US dollar being the dominant reserve currency around the world, which really gives the states a lot of advantages and leverage over other countries, especially with issuing sanctions to help influence other countries' actions and policies, of which is also a big source of criticism, because it's not really retail driving gold's rally like it is in Bitcoin, because we've actually seen assets and gold ETFs fall, and mentions of buying gold and social sentiment towards gold nowhere near breaking out to all-time highs. This is more wholesale buying by sovereign states looking to fill their reserves with the precious metal instead of US dollars. And it's also helping a bit of a catch-up trade in gold miners, which have severely underperformed for a long time now. They were the best performing sector today, up 1.65%. Just moving on to the fear and greed index. Dropped a little bit here today, still in the greed zone. Corporate insiders were still doing a lot of selling on Friday versus buying. And there's a look at crude oil futures, just holding ground above the 50-day VWAP here. We do have a little bit of negative seasonality coming into the market over the next 2 weeks. Pretty good bounce in Chinese securities here today. Large cap ETF up 2.5%. Clean energy still stumbling along, and a mixed day for international stock indices to start the week, with China the winner and looking more and more by the day that we have put a bottom in here in mid-January. Second weakest sector today was semiconductors. Pretty much just looking like Nvidia there, fallen again, and once again a bit of a rotation to energy, oil and gas, breaking out to multi-month highs here. Financials still in that parabolic uptrend, and industrials holding ground as well. And while we've got those growth sectors holding up, we've still got a little bit of a defensive rotation going on. You can see that in utilities and staples as well. Whilst we continue to see a bit of hot air coming out of these momentum stocks. Apple trying to hold ground there, along with Alphabet, but the biggest fall in Meta we've seen in quite some time. And Tesla still looking soft, just trading below 180 a share. And these other hot stocks coming off a little bit here today. AMD falling over 4%, and the other ones we've been watching. DraftKings lost its 50-day. CrowdStrike, Vertiv, Wingstop, and Abercrombie & Fitch all fallen again today. These were some of the hottest stocks in the market these last couple of months. Clearly taken a bit of a turn here. Alright, there we are for this pretty quiet Monday trading. Things could get more lively tomorrow after we get that CPI print in the morning, and we could have this parabolic uptrend tested if that were to come in a little hotter than expected, or maybe either way if the market uses it as a liquidity event to get out. But for now, the parabolic trend remains intact. Most sectors remain above their 20 and 50-day medium-term uptrends, and the market is very much expecting inflation to come in as expected. Thanks very much for tuning in today, and I'll see you again tomorrow night. Cheers.